So good evening everyone. I hope I am audible. Okay, thank you. Okay, so you can give your attendance in the chat box. I have started with the presentation. In case you're not able to view it, just let me know. So you can see today we are going to start with block 3, and it is the application of cost accounting. How we are going to use cost accounting. So the application of cost accounting is in various fields. Mostly it is used to ascertain the profit. As I said yesterday, that when you have the cost per unit, you can add the desired profit in it, and then the result is sales. So it makes you understand what is the effect of cost on profit, on sales, so that you can start quoting the price, or the business can start earning profits accordingly. If when we start with this block, the first chapter is related to cost volume profit analysis. This is also known as CVP analysis. So cost volume analysis means that you can see cost is the price, volume is the quantity, and profit, of course, it is the gain. So what is the relation between cost, quantity, and profit? If we want to increase the profit, how it is going to affect the quantity, or at what quantity we can sell the products, so that we can have a no profit, no loss. The first important thing to understand is that actually we are not going to sell the products below the cost price. So in order to find what is that level where our cost equals to our cost of production, the sales equals to our cost of production. Sale should be equal to or more than the cost of production. If not more, then at least in cases it is expected to be equal. If it is not equal, it is below, then what will happen? It will be a loss. So when we start with the structure, we will study what is CVP analysis, that is cost volume profit analysis, how it is impacting, how the factors are affecting your profit, how we are going to find the cost, different cost, and then of course the keywords. If we start with the first part, we need to take the managers, the business, the entrepreneurs, they need to take frequent decisions which involves consideration of selling prices, variable cost, and fixed cost. And I hope these three terms are very clear with everyone. What is selling price, what is variable cost, what is fixed cost. So in order to put or quote a price, we need to find out the variable cost and the fixed cost occurred in the production. So when we try to find out the cost volume profit analysis, we want to do a analysis related to the cost. Then in that case, we need to find out measure the effect of changes in volume, cost, and price and product mix on profits. If we increase or decrease or remain stable with the volume, how it is going to affect the profit. The second one, it states that if we are going to make any changes in the cost, increase, decrease, or stable, how it is going to affect the cost. If there are changes in the price or no change in the price, how it is going to affect the profit. And the last one, they're talking about product mix. If we mix 2, 3, 4 products, then in that case, how it is going to affect the profits. So all these factors, whether it is a volume, that is quantity, whether it is cost, price, their effect on profits need to be analyzed. So who is joining? Okay. So now if we want to find out that how the CBP analysis is undertaken, this is a division of cost into their variable and fixed element. Like first you take sales. Sales minus marginal cost is contribution, and contribution is result. So sales minus marginal cost is known as contribution. From the contribution you minus fixed cost, it is your profit. So in order to understand profit, we need to find out what is fixed cost, what is marginal cost, and what is contribution. So this is a model, CVP is a model where we can find the effect of different elements on profit. This is used as a strategic decision by the fund managers, by the financial managers in the organization. So what we are going to study here, the impact of factors of profit first, how price changes on net profit, how volume changes on net of profit. When we mix price and volume both, how it is going to affect your net profit. If there is an increase or decrease in the variable cost, what is its impact on net profit? Then an increase or decrease in the fixed cost, how it is going to affect the net profit. So all the four factors that we are going to take into consideration, they are price, they are volume. Again and again, I am repeating, volume is the quantity, number of units produced, fixed cost, and net profit. So it is price, volume, variable cost, and fixed cost. These are the four factors. What are their impact or effect on net profit that we will be studying. So here it is, one question given. It is the assumption that the sales volume is 2 lakh units at a selling price of rupees 2 per unit. Sales volume is sales quantity is 2 lakh units. They have a sales of 2 lakh units and the selling price per unit is rupees 2. The investment in the business is also 2 lakh rupees and the management expects to earn a fair return on it. That means a normal return which is prevailing in the industry. The fixed costs are 1,60,000 and the variable expenses are rupee 1 per unit. So, if variable expenses are rupees 1 per unit, that means for 2 lakh units, what will be the variable expenses? It will be 2 lakh only. So, for different three situations, we are going to identify the effect as per the three different situations. The three different situations are that the first one is normal volume. Normal volume is 2 lakh units. Then they say there is a decrease in volume and price by 10%. And the third condition is there is a decrease in price by 20%. While an increase in volume price for the same percentage is shown on the right central column. So we will see what is the break-even point where we can get to know. So this is how we are going to analyze it. The first one is your decrease in price. The second one is normal volume. And the third one is your increase in price. Units, in the first case, it is 2 lakhs, 2 lakhs, 2 lakhs and 2 lakhs because there is no increase or decrease in volume. Sale is rupees, sale has increased. So sale in rupees is 3,20,000. How 3,20,000? Just listen to me. The first column is decrease in price. Decrease in price means what is the price? 2 rupees. So if there is a decrease, then 2 rupees, 20% is decreased. So it means that the cost is 1 rupee 60 paisa. Am I clear?
No.
Yes, Manuel?
I didn't get you,
No, ma. We need the analysis,
bro.
the calculation. Ma, how do you realize 320,000?
What
The
I'm
first stage.
saying, it
Okay,
means
ma.
that you are
The
not,
first sale
it
was 4
means
lakhs.
that you have,
Or where can we get it? The first sales. So excuse me.
it means that you have not read the question, not understood the question. What the question is, get back to the question. The question states that 2 lakh is the units sold and what is the price of each unit? The price of each unit is rupees 2. Am I clear till this? Yes or no?
Yes.
Yes, ma'am.
Mama, in that the previous sentence is clear to 2 lakh units, but unit of the series is not clear. Units of the series only in the table.
So it is 2 rupees per unit. So when it is 2 rupees per unit, the first case they are saying there is a decrease in 20% in the price. Not only in the price, in the volume also. So first we are going to see how it is affecting the price. So if there is a decrease, that means it will be less than 2 rupees. What is 20% of 2 rupees?
Uh, 0.4.
Okay. So 2 minus 0.4, it will be 1.6.
Yes.
1.60. So that is
Yes.
what we are calculating here. We are calculating it in the form of decrease in price. So sales is rupees 1.6 per unit. So 1.60 multiplied with number of units 2 lakh, you will get 3,20,000. Am I
Yes.
clear now?
Yes, ma'am.
Yes, ma.
Okay. Now variable cost is there is no change. So variable cost is rupees 1 per unit. It remains 2 lakh because there is no decrease in the quantity, 2 lakh units. So what happens, Salome? Kindly mute yourself. So now sales minus variable cost is marginal cost. If you remember the flow chart, sales minus variable cost is your marginal income. So 3,20,000 minus 2 lakh, you can see this 1,20,000. This is your marginal income. In this marginal income, you are going to add fixed cost. So marginal income minus fixed cost is your marginal cost minus fixed cost is your profit. So fixed cost is how much? 1,60,000. Okay. Fixed cost is 1,60,000. So 1,20,000 minus 1,60,000. You have less income, and from that income also you require to pay certain amount as fixed cost. So the answer is in minus. So it is not a profit. In this transaction, there is a loss of rupees 40,000. There is a loss of rupees 40,000. Okay, your income is less and your expenses are more. You can see here in the question it is given fixed cost rupees 1,60,000. Okay, we have not added anything. It is as per the question, as per the information provided in the question. So it is 40,000. So what is net profit or net loss? Net loss is of rupees 40,000. Am I clear?
Yeah, teacher. So, sorry. Why are you putting this 4,000 in bracket?
I have a quick question. Is it since we are dealing with 2,000 units, 2 lakh units of the product, while I think you said that for each unit the sale cost is 2 rupees, while
Yes.
while the total cost for the production is it 1 rupee or what? That is what I didn't understand.
See what happened. The question says, you can see what is given in the heading. Decrease in price. The first case is 10%. Can you see this? 20% and 10%?
Yes, ma'am.
You can see.
Yes.
So decrease in price of 20%. So what is the total cost? 4 lakh rupees as per you. If it is 2 lakh units multiplied with 2, it should be 4 lakh. What you are saying? Am I right,
Yes.
Anas?
Yes.
Okay. But there is a decrease in price of 20%. So if it is total 4 lakh, what will be 20% of 4 lakh?
0.4 rupees.
That means 80,000.
Yes.
So
Ye-
4 lakh minus 80,000, you get 3 lakh 20,000. Or else, if it is 2 rupees, what you are saying? 2 minus 0.4, that is 1 rupee 60 paisa, 40 paisa is minus. So 1 rupee 60 paisa, 1.60 multiplied by 2 lakh, you will get 3 lakh 20,000. So here how it is not 4 lakh, it is 3 lakh 20,000 because there is a decrease in the price.
Okay.
You understood?
Okay, ma'am. Yes, ma'am.
Just for saying yes, or actually you understood?
Yes, ma'am. I really understood.
Okay, thank you so much. So this is
Okay.
the first case. Now same we are going to see it if it is 10%. Now it is in front of you. Just try to analyze on the same way which we have done for our decrease in 20%. See how it is changing. Yes, Salome, you want to say something?
Yes, ma, I have a question.
Yes, Salome.
Okay. Yeah, so I understand how we got 3 rupees 20,000.
Okay,
Yeah, on 10%, and I also understand how we got 3 rupees 60,000.
very
But
good.
yeah, but then I don't understand how we got four. Is it 4,000 rupees from the normal price and the increase in price?
I will come to increase later on.
Okay.
And I just finish off with the 10%, then we will move to that. As you have done decrease in price, same way normal price, this normal price or normal volume which is given now, this normal volume is the information which is given in the question. Here we are not doing anything. Either we are dealing with the decrease or increase. Am I clear? In decrease, we take the lower value. From total value, we deduct the decrease percentage. And when it is increase, in the normal value, we add the increased percentage. This is the way how we deal with. If it is a decrease, it will be minus normal. If it is increase, it will be plus normal. Yes, Ravi?
As in the first row, the units everywhere is 2 lakhs. How it is?
It is question, Ravi. It is given in the question that the
But
units produced sold is 2 lakh rupees.
if
We
there
are
is a
not
decrease in
not
volume,
decrease here. Nowhere it is written decrease in volume. It is decrease in price, and in the second one it is increase in price. We are not making any changes in the volume. Okay.
okay, thanks.
So the 10% is clear.
Yes, clear.
You understood? Others also, do you understood what is 10%, how the calculation is made? Now you come to normal. From this normal, we are again going to move to the next one, that is increase in price. Remember, units are fixed. So 2 lakh is the unit. Now we are increasing 10%. Okay. So normal is 4 lakh. What will be the 10% of 4 lakh? 40,000. So 4 lakh plus 40,000, you can see the sale price, the sale value is 4 lakh 40,000. Am I clear? Now next it is variable cost. As variable cost, if you remember yesterday's class, variable cost changes with the changes in the volume. But as there is no change in the volume here, the units are fixed. So whatever information is given in the question related to the variable cost, we are not going to make any change. 2 lakh units and 2 rupees per unit. So here the variable cost is 4 lakh 80,000 because 4 lakh 40,000 is your sales. Am I clear? And what is 2 rupees variable cost? 2 rupees per unit. Variable cost is 1 rupees per unit. So 2 lakh multiplied by 1, your answer for variable cost is 2 lakh rupees. Now, when you have variable cost, so what is marginal cost? Marginal cost is sales minus variable cost. Sales is 4 lakh 40,000. Variable cost is 2 lakh. So, the answer is 2 lakh 40,000. Your marginal income is 2 lakh 40,000. Marginal income minus fixed cost, which is 1 lakh 60,000. So, your answer is 80,000. Net profit in the first case, when it is a 20% and decrease and 10% decrease, you see there was loss of 40,000, and in the second case it was no profit, no loss. It was break even. But as we increase the price by 10% from 0 to 80,000, you can earn profit. And if on the same way you increase the price by 20%, in that case your profit may rise up to 60,000. Up to 1,20,000. So this is the difference, that if we decrease the price, units remains the same. There is a loss. But if there is an increase in the price, then we can see an increase in the profits also. Just have a look in this calculation so that we can move to the next.
I think what makes many of us being confused is the relationship between the sales, the variable cost, the marginal income, fixed profit net, and the rest. I think what many of us from the beginning, I think, didn't understand, even maybe by myself, is the sales. Yes, ma.
The relationship is
Yes,
that
yes, ma. But
if we
now,
yes sir,
yes, ma. But now I think I understand it, because what I understand is from the sale we can get
yes,
the marginal income from the variable cost, which includes the raw materials, among other things that we use. So we subtracted the variable cost from the sale, the total sale. Therefore, we get our marginal income. If we get our marginal income, then also the fixed cost that we, I think, treated yesterday, we will subtract the fixed cost from the marginal income. Since for now we have a reduction of 20%, while the marginal income have been decreased. So this causes our loss of 40,000 rupees. So I think
yes,
now I understand what has happened, and also the relationship between what we are treating today and what we treated yesterday.
okay. Thank you so much that at least you understood the relationship, because at
Yes.
times we just go
So,
on doing the
teacher,
questions. Yes,
madam, yes,
yes,
sorry,
yes, yes.
uh, I understood you until the point where we was talking about the net profit, net loss here, where we have 40,000, and from
Yes.
that I didn't understand the rest. When it comes to net profit, net loss here, where we have 20 and then 200% minus. I don't know how did you manage it to get a minus 200%. Tisha, are you there?
Who is talking? Is it Villa?
No, it's me, Sixpence.
Okay, sixpence. You tell
Manuel.
me.
Yes,
Let
I
me
was
write.
asking about this 20 and then minus 200%. I didn't get well here.
See, this is what it is per unit percentage change in profit. How much you are having a net loss if you compare it with your price. What is the net loss? 40,000 is
40,000.
40,000. If you
Yes, which
compare
is
this 40,000
90%.
with 2 lakh, how much it is? 0.20.
Yes, ma'am.
Okay, so when you compare, when the units at 2 lakh, there is a net loss of 0.20%. So
Yes.
how much it is going to change? 0.20, if you convert it into percentage of 2 lakh, it is minus 200. Loss is 40,000 na. So this 40,000, if you convert it into percentage, it is a loss of 200%. That is why it is in minus.
Does it become 200 or 20%?
20 is the first one. It is 200.
How 200? Because 40 over 200 times 100. 40,000 over 2 lakhs times 100. It becomes 20%.
Okay, move to the volume. Just a minute, I have moved to the volume. Yes, this one. You have calculated? Just calculate. Give me 2 minutes time. Let me take the calculator. See here, this is return on investment is minus 20%. It is same what we are talking about. 40,000 multiplied by 100 divided by 2 lakhs. So it is, what is your return? The return is, there is a loss of 20%. So it is written as minus 20.
Yes, no, the previous row where there is minus 200 minus 100.
You are talking about percentage change.
Per unit rupees.
You are talking about this 200.
Yes.
This one which I have highlighted.
Yes. Yes.
Okay. We are trying to find out the percentage change in profit. Percentage change. We want to find out the change. When we need to find out the change, that means we need to compare it with something. So what we are comparing it with? We are comparing it with the normal volume. What is the normal volume? In the normal volume, it is 40,000 profit, whereas in the decrease in 20%, it is minus 40,000. So this 40,000 and minus 40,000 compared to your 2 lakh rupees units, what is the change?
Okay. Okay. Yes. Got it.
Got it now? I
Got
was
it now.
also confused at what you are asking. When we are saying percentage change, always remember change is comparative study. So we need to find that the normal volume is 10%. This is what actually we are studying. What was our topic? Impact. So what is the impact if there is a change in the price or there is a change in the volume? So normal it was a profit of 40,000, and now if we decrease it by 20%, it is a loss of 40,000. The units are same. So if units are same, in one case it is 40,000 plus and another is this 40,000 minus, then what it is in terms of percentage.
Yes. Okay. Got it now.
Got it? And
Got
the
it. Yes.
second case, yes, second case also you see the same thing, 40,000 and here it is 0. If we
Yes.
if we decrease the price by 0, that means it is only minus, here it was 40,000 but here it is 0. That means it is a break even point where there is no profit, no loss. That is why it is minus 100%.
Okay.
There is no profit, so it is a minus 100%. And same way, when it is a profit of 80,000, it is plus 100. When it is a profit of 1,20,000, that is 0.60, it is a change of plus 200%. And this return on investment is calculated simply on the loss or profit percentage compared with sales units. Okay.
Okay. Yes.
Now the second part of this is what we are going to study: the change, the impact of change in the price with the quantity, the impact of change in volume. So the next part of this is that influence of volume changes on net profit. So what is the volume? Now I hope everyone remembers that the units were 2 lakh in all the cases. Everyone remembers?
Yes, ma'am.
Okay. Now we have to make a change in that 2 lakh units. All the calculations will be as per the new units that you will receive. So let us take the central part. The central is the normal volume. The normal volume is the one which is given in the question. The information is provided in the question. So what is the normal volume? 2 lakh rupees. In that, yes. Okay. So normal volume is 2 lakh rupees. In this 2 lakh rupees, sales is 2 rupees per unit as per the question given information. So it is 2 lakh multiplied by 2, it is 4 lakhs. Then what is the variable cost? 1 rupee per unit. So 2 lakh was the units. 2 lakh multiplied by 1, it is 2 lakhs. Then what is marginal income? 4 lakh minus 2 lakh, 2 lakh. Fixed cost 1,60,000 minus. So the normal case, the profit is of rupees 40,000. This is as per the information provided in the question. Now we will start with the calculation of R's. The first part of the calculation is if there is a decrease in volume. Volume is your units. Which unit? The 2 lakh units. So the first case, 20% decrease. So your units are 2 lakh. What will be the 20% minus of 2 lakh? 20% is 40,000. So 2 lakhs minus 20,000, 40,000. Your units produced or units sold is 1,60,000. Am I clear till this?
Yes, ma'am.
Now the second case is sales. Sales is rupees 2 per unit. So now in this case, 1,60,000 is your unit sold. Multiplied by rupees 2, your sales is rupees 3,20,000. Now, what we need to find out? Variable cost. If you remember, variable cost changes with the change in the unit. Again, I repeat, variable cost fluctuates, changes with the change in the unit. So what is the variable cost? Rupees 1 per unit. So how many units are produced with a decrease? 1,60,000. So 1,60,000 multiplied by 1, your variable cost is 1,60,000. So sales minus variable cost, answer is marginal income. So 3,20,000 minus 1,60,000, your answer is 1,60,000. Fixed cost never changes with the change in the volume, with the change in the output. So whether it is 2 lakh, whether it is 1,60,000 or whether it is 5 lakhs, the fixed cost which is given in the question 1,60,000, it is going to remain the same. So marginal income minus fixed cost, both are same. Your answer is return on investment is 0%. That means it is a situation of no profit, no loss. Whatever is your income, that much expenditure you are making. Am I clear? I hope this is very clear.
Yes, ma'am, it's very clear. But we need
Yes, ma'am.
further information.
It's
So now
very
you
clear, ma'am.
just look into the table for if there is a decrease in 10%, and the same way if there is a increase in 10% and 20%. Quickly just see to it and see you are able to understand. Only you are going to make the changes in the units, and rest all things are going to change accordingly.
Mama, we understand the numbers in the table, but we need other information about the 100% and 50%.
Just read this explanation. A 20% decrease in volume reduces the sales to a break-even point where it is constant because variable costs change in proportion to sales. In the second case, a 20% increase in volume improves the profit by 100%. And if we go similarly with increase by 20, then also we can see that the profit increases.
One question. The variable cost is same as the capital investment.
Yes, please.
The variable cost is same as the capital investment from the question.
Capital investment means what you're talking about?
In the question, there is a capital investment of 2 lakh.
It is not capital investment of 2 lakh. It is 2 lakh is your unit sold.
No,
Sales unit.
we have another 2 lakh just below it.
This is the table. Show me where it is.
In the question,
Shall I come back to the question?
Yes, in the question. Yes,
there
you
is
have 2 lakhs just below it. You have another 2 lakhs capital investment.
Okay. So here we are comparing with 2 lakh is the investment. And what against this 2 lakh, what is the profit? This is what we asked, na? Percentage change in profit. Profit is compared with what?
Investment.
With the investment. So that what you are asking, 100%, 200, it is compared with this 2 lakh rupees. Profit is never, percentage change in profit is never compared with your sales. Always profit is compared with your investment.
So,
I think what she didn't understand is the capital investment is the variable cost. So is
No,
the
capital
cost of the
investment is not
production.
variable cost. Variable cost is the cost which is incurred for functioning of the organization. In order to produce 2 lakh units, the expenses that has incurred, it is proportionately distributed as variable cost and fixed cost.
okay, yes, I
Investment is
got.
the amount. Okay. Investment is
Okay,
the
got it.
capital.
Yes, okay, got it.
Okay.
Yeah, ma'am.
Yes.
It looks like to understand this cost account, we have to understand firstly the theories behind it, and then it becomes very easy. For example,
That's what I told you yesterday. We should go
yeah,
with each and every terminologies. Okay? And
yes,
that is the reason why the content, the study material is given to you in advance. What we do,
of
we
course,
never go. It's a normal thing, na? When we study, we also do the same thing. We never go when we attend the workshop seminars as a teacher. We are given lot of case studies and then handouts. But what happens when we reach the seminar? We never come prepared for that because we don't read them. And then when they ask, we are all blank. So same thing is
yes. So
happening here.
yeah, what I was about to ask from you, maybe next time, maybe tomorrow, if possible, you can bring it as an Excel sheet and then start introducing the values and then calculate, because some of us, as you can see, we have different skills when it comes to calculations or mathematics. You see, that's why
No,
you
I
know,
can
to
do that.
solve.
Manual, I
Okay,
understand. I can do that. But you see,
okay, thanks.
within this given one block is given for one day. Rather, you should ask Smriti ma'am to give us more counseling sessions, because
Okay,
completing 4 5 units, 4 5 chapters in one block, that too in a one day, it is not a theory. Because for practical,
okay,
we need more counseling sessions. Theory, it's okay. We can read and
of
understand.
course.
So
Okay, thank
we
you.
as a counselor manual, we cannot say. And if we start doing these questions now, then in 1 or 2 questions we will end up with the time.
Okay, thanks.
So maybe that if we get 2 days for one block, I think we can do at least some justice with the topics. Otherwise, what it will be? It will be otherwise, we are supposed to only clear your doubts. We are supposed to only throw light on what are the contents, what are the terminologies, what are its implications. That's all. I face this problem in the second semester students also, those who are now in second semester. So they also had this, because in the second semester also you will be having one paper which is financial management, and that is more technical with lots of questions, lots of practical part. So again, the same thing. So it's my earnest request that at least just have a look on what we are studying, what we are going through. If you come prepared with the next block for the next day, it will be something helpful for the counselor also. What she what she is doing continuously, she's not having network proper. So I am skipping this graph part because you cannot understand this graph part here, and I will not be able to do also this graph part. This is all charts. What is she doing? Your network is not proper. You just write, Omar Aliu, you just write what you want to say in the chat box, because there is a problem with your network, I suppose. There is continuous disturbance.
Madam, it's
Okay,
a
so
question.
what?
I have a question. I have a
Yes.
question. It's regarding the assignment on this, which is a question is given based on cost profit volume analysis. That is question one. Under this question, um, there is one sentence which didn't specifically stated whether the cost is a fixed or variable, but it just said the various expenses were RS. That's how it said, but it
Can I
didn't
have
specify
that
whether.
question? See, I don't know what is that question. We are not able to see the assignment questions. So it will be nice if you can give me that question.
All right, madam.
Okay.
I will share the question. Thank you.
I have given you my email ID. You can send the question to me. Tomorrow I will get back with the question.
All right, madam. Thank you.
Okay, I'm just again sharing my email ID. You just mail me in this. You mail me in this. Okay.
All
I've
right,
given
ma'am.
my ID in the chat box. You mail me the question because we don't know what is the question. We don't prepare the assignment. It is from
All
the center.
right, madam.
Okay. But it will come to me for checking, because whatever subject we are taking in the counseling, the same we need to evaluate.
All right.
Okay. Yes, what happened, Ravi?
Yes, in the first table, the break-even point in table
Yes.
9.1.
Yes.
How to obtain these values?
Break-even point is a point where there is no profit, no loss. The sales value is equal to the cost of production. Okay, where your cost is equal to your sales price. So that is the point which is known as break-even point, where there is no profit and no loss. So we need to find out that what is that unit, what is that break-even unit where we actually need to sell the products up to a certain unit where there is no profit, no loss. And once we attain the state of break-even point, from there we start earning profit.
So houses values are obtained 4,26,000.
The values are as per the calculation, as per the information given. Sales minus uh, what we have done, variable cost, that is marginal, minus your fixed cost.
Whether they valued 4,26,000.
Yes, you do it, the calculation, you will get it in terms of percentage. You multiply it, you will get. We will come to that. We have a calculation for break-even point. That's why I have not explained it there at that point.
Okay,
Okay?
okay, okay.
There are so many questions given. You just go through the questions. Now, this is something easy, budgeting and budgetary control. We all know what is budgeting. Yes? You all know what is budgeting?
Yes, we know.
We know. We do it for ourselves also. How many of us do it for ourselves? Budgeting is making an estimation of income and expenditure before they actually occur. Am I right?
Yes, madam, you're right.
Yes, you're
Okay.
right.
So when we say budget, preparation of budget is the estimation of all the probable incomes and the probable expenditures which is going to occur in future. So this can be the individual budget, this can be our household budget, this can be the company's budget, this can be the office budget, and this is also done when it is a national budget, when the Prime Minister, President, they present it in the parliament, in the houses. So budget is not restricted to any organization or any individual. Even before getting the salary, we make an estimation that what is going to be a salary and what are the probable areas where this salary has to be used. So if we do not go properly, if we do not plan proper allocation of the expenditures against the estimated income, then there will be no way to meet the expenses. We will not have any particular path. We will not be able to follow the path. So in order to reach to the destination, we should have a clear idea about which route we have to take, which path we have to follow. Same way it is with budgeting. So in financial term, budgeting is a financial planning. Financial planning of what? Of your income and expenditure. It is not necessary that my income is only with one source. Okay, I may have a fixed income which I go from for office from morning to evening. Besides that, I go for some part-time job also. I have a small business also, and there may be some income which I get against my parental property. So there are so many areas through which I receive income. So we need to make a total estimate what is going to be my total income for this month. Against that income, we make a list of the probable expenditures. Why we do so? So that when we go for meeting the expenditures, we come to know Are we have that sufficient amount with us to meet all the expenditures? And if not, then what we are going to do? Either we are going to postpone certain expenditures for the next month, or else we are going to borrow. We are going to borrow it from some sources if that expenses are very crucial. They cannot be avoided for next month. So this is what we call as financial planning. So this financial planning is important in the budgetary control. So what is a budget? It is a expression, a plan in terms of money. We need to prepare it in advance so that the strategies related to income and expenditures can be drawn. So when we talk about budget, there should be a budgetary control. There, the budgets are prepared on various types. It may be on the performance, it may be on the basis of sales, it may be on the basis of your um, income, it may be on the basis of your cash. So each and every aspect can be compared as can be done in the form of budget. So this is the classification of budgets. You can see the budgets can be on the basis of time, long term budget, short term budget. What is your plan for next 15 days? What is your plan for next 3 months? What is your plan for next 12 months, for next 5 years? So this is what we call it as a long term and short term budget. Current budget, the budget which is prevailing now, and rolling budget, the budget which is carried from the previous year. Am I clear with this time element?
Yes, madam.
The next one is on
Yes,
the
it's so
basis
clear.
of The next one is on the basis of functions. On the basis of functions, it can be sales budget, it can be production budget, it can be the cost of production budget, where we make the calculations only to find out the cost per unit. It can be purchase budget, it can be personnel budget. Personnel is related to human force, the force, human resource that is working. So that is also a budget. How many people are working presently in the organization? What is the demand that is going to arise? How we are going to manage with the people whom we are going to recruit in future? It can be related to research budget, it can be capital expenditure budget, it can be cash budget, and it is a master budget where all the above elements are included. In an organization, if you include all the elements in one budget, it becomes your master budget. And when it is on the basis of flexibility, it can be fixed budget, it can be flexible budget. Budget never changes. Fixed budget never changes whatever is the condition. Flexible budget, it can be changed. Like variable cost changes with the output, with the units, same way flexible budget also changes, but fixed budget never changes. So these are the types of budgets that we do. Just taking a break of 5 minutes. Okay, I will have a glass of water and come back. Just taking a break of 5 minutes. Okay, I will be back.
All right, madam.
Okay. Hope everyone is there.
Yes.
Okay. So we have discussed all these budgets. Okay, now we will see one or two questions related to budget. What it is? There are three sales division. This is a sales budget. There are three sales division: Madras, Bangalore, and Hyderabad. Three places. It sells two products, 1 and 2. The budgeted sales for the year are like this. For Madras, product 1, product 2, 50,000 units for rupees 16, 35,000 units for rupees 10. Second one, 55,000 units, and for the only second unit sells only second product, and third unit sells only first product. So this is what they have given, that the budgeted sales for the year ending is this. This is the budgeted sales. And what against this budgeted sales, what is the actual sales? For Madras, the budgeted sales was 50,000, but here it is 62,500. Here it was 35,000, here it is 37,500. Next, Bangalore product 2. It was estimated for 55,000 units, it is 62,500. And second one, it is 75 units, it is 77,500. So from here we can see that all in the actual sales, all have increased. Now when we go with this, the report, what is the report? The report says that 50,000 unit, and here it is 62,500 unit. Here it is 35,000, and here it is 37,500. Now the report of the sales department, it was estimated that for the product 1 and product 2 of Madras, there will be an increase of 4,000 and 2,500 units. For the second one, it will be 6,500 and 5,000 respectively. Intensive sales campaign in Bangalore and Hyderabad is likely to result in additional sales. So this is their estimation. Now, this is the format of your budget. You just have to put it in the same format. So you need to calculate it on the basis of this. Simple way, nothing. You have to just see what is the rate, what is the quantity, and then you multiply it. So different budgets can be prepared. We cannot go with the detail of these budgets. So budgeting is clear. Budgeting is the estimation, and different formats are given for each type of budget. Kindly go through them, and in case there is any doubt, we can have it in the last day. Okay, you need to go with a practice. All types of budgets are there, whether it is sales budget, purchase budget, overhead budget, factory budget. Every type of budget is possible, because budget is nothing but it is only what? It is your estimation of what you are going to perform. The next topic in this is controlling ratios. Control ratios are again associated with your performance, cost. There are three types of ratios. Activity ratio. Activity ratio, it measures the level of activity you have attained over a period of time. So, in activity ratio, we go with the standard hours for actual production divided by budgeted hours multiplied by 100. So, to complete a certain activity, what is the standard hours required? That is on the basis of actual. What is the budgeted hours? What you expected? And this has to be multiplied by 100 because this has to be expressed in percentage. The second part of this is capacity ratio. The capacity ratio means what is the efficiency and how much working hours is expected and how much working hours has been worked. So it is actual hours worked divided by budgeted hours, which you have estimated, multiplied by 100. And efficiency is the actual hours. The ratio indicates the degree of efficiency attained in production, what you expected and what you have attained. So this is all about the ratios. In order to find out, you have to solve the questions. Much things are not given here. Next, we have in this one important aspect in budgeting is zero-based budgeting. Now, when we talk about budgeting, for a budget, we always have a plan. Now, I will give you an example. When we talk about budget, we say if it is a sales budget, and I hope we people all are working, so you will agree also with me to a certain extent that if I prepare a sales budget for this current year, so I will say last year the sales target achieved was 1 lakh units. So what is my conclusion? That 1 lakh units sales target can be achieved or has been achieved. So this year when I will fix the target, I will fix it at a increase of more than 1 lakh. It can be 1 lakh 50,000, 1 lakh 20,000, anything. Okay, but it has to be more than 1 lakh. So this is what actually we do in budgeting. In budgeting, we take the base, the data of the previous year, and on the basis of the previous year's data, the current data is compared. The current budget is prepared. There is one term or one aspect in budgeting which is zero-based budgeting. Zero-based budgeting means that the base is zero. In all the other budgets, the base is your previous year's. But in zero-based budgeting, we start preparing the budget from a scratch. Whatever is the previous year's performance, we do not take it into account and we prepare a fresh budget as if the company is a new one. So every year when budget is prepared, if we are following the zero-based budget, we are not going to uh, take into consideration the budget of the previous year. Am I clear till this? Am I clear?
Yes, ma'am.
Yes, you are clear.
Everyone? So zero-based budget and the other budgets, this is the only difference where we do not take into account any data of the previous years, whatever is the performance. Nothing is taken into account. What we do, we only take into account what we need to do right now, the present performance. We started from a scratch and we believe that whatever is the performance of the previous years, that is zero. Okay? Is that clear?
It's clear, doctor.
Okay. Now I'm coming to the next one. After zero-based budget, Zero-based budget says that there is no consideration for ongoing activities. Every time it is new. Again and again, I keep on repeating that please go with the keywords that are given at the end of each chapter. The keywords are terminologies used for the particular chapter. So kindly go through it. Now next we are coming to variance analysis. Now variance is the deviation. Variance means, suppose I say I targeted for 1000 units of sales. Now my sales is only 800 units. So there is a shortage of 200, or my sales is 1200. So there is an increase of 200. So why there is a shortage or increase? What is the reason that the actual and the expected is different? So this difference is known as variance. We need to understand, we need to do the variance analysis. The variance analysis can be of material, it can be of labor, it can be of profit, anything. So when we talk about variance, what is variance analysis? Yes, tell me. Variance is the difference between actual and expected. Am I clear?
Yes, very clear.
Okay. So variance, it is this. So when we say that we have moved from the actual, from the estimated, actually something different. So this is known as deviation. So why this deviation has occurred? The study of the deviation of actual versus the planned one in budgeting is known as variance analysis, and it is very important for each and every organization to know the reasons. They should be concerned with how the difference of actual and planned behaviors is has happened, and how it indicates the performance of the business. Okay, so when we start with variance analysis, the variance analysis can be for each and every type that we take. In variance analysis, we try to compare the predicted cost of behavior of a business with the actual number of the outcomes. What is expected and what actual has happened. So the variance analysis can be, you say, related to purchase, it can be to sales, it can be overhead, it can be efficiency variance, it can be labor variance, it can be material variance. So any deviation in any of the form can be studied under variance analysis. Am I clear? So you can
Yes,
read
yes,
the
doctor.
read the first one. Variance is the difference between budgeted and the actual level of activity. Okay, so if you say it is cost variance, then it should be the cost which we say it is a standard cost, and it can be compared with the actual cost, what we expected. If it is a sales variance, then the difference is what should have been the sales, that is the budgeted sales, and then we compare it with what has been the actual sales. So variances are mostly distributed into two categories: cost variance and sales variance. So when we talk about cost variance, under cost we know three things are there: material, labor, and overhead. So direct material cost variance, direct labor cost variance, and overhead cost variance. Same way, if we go with the Next part, that is sales variance. I'm coming to it. These are all computation. Cannot go with this. Yes, it is the sales variance, and under sales variance, we will have sales price variance, sales volume variance, and sales value variance. Sales price variance is the price per unit. Sales volume variance is the sales volume, that is in terms of quantity, and sales value is in terms of total revenue generated. So in all this, we are going to find the difference between the actual and the budgeted. Why we go for study of variances? Because if the variances are there in the organization, we should understand the reason, and if the variances, if the deviation has a high degree, we need to control those variances. If we expect a sales of 1000 units and the sales is only of 500 units, so we need to understand why there is a difference of 500 units. Either your budgeting, your estimation is wrong, or else there is something wrong with the present performance. So this is the, if you go with this one, variances, this is the final chart where you have to study at least with the theoretical part of all these variances. For all variances, you have to go with fixed variance and variable variances. Am I clear? So these are the three topics that we have done. I don't think there is any more thing to be continued in this. Yes, this is the last page. So all the topics for today, it is done. Nothing is left. Just let me know if anything is left. All the chapters that is given is completed. So anything from your side? The forum is open. Just let me know anything from your side. I hope everyone has given your attendance. Oh, Anas, it's my pleasure that you understood all the things. You don't have any confusion. Thanks to everyone for your patience listening and having a clear-cut understanding. So in that case, shall I end the class for today? See you tomorrow with a new topic, new block, fourth block.
Wenda bangono. Yeah.
Thank you, Salome. You understood.
Thank you.
Salome,
Thank you,
tela la
ma'am.
ndani Salome, 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 tela la ndani.
Thank you, ma.
Salome. Okay, Salome.
Okay, Mama, thank you. Have a nice night.
Thank you, Doc. Thank you, Derek.